Back on Morning Movers, we'll get a closer look at the networking space after the closing bell when Cisco reports its quarterly earnings. Analysts are expecting adjusted EPS to come in at 91 cents a share on more than $14 billion in revenue. Keep in mind, Cisco shares jumped to a 52-week high after reporting Q2 earnings in February. The stock is currently trading about 7% below those highs in the pre-market. Time now for Options Corner. Joining us to take a deeper look at Cisco is Rick Ducat, lead market technician here on Schwab Network. All right, Rick, I know year to date that Cisco's been outperforming the S&P 500, but what trends are you seeing here?
Yes, broader outperformance in this name here. Tech was suffering even worse than the general market here, but now it's caught up. Cisco remains up about 26% during the past year and quite tightly correlated to the S&P, as is common in this current news-driven environment. What we can see here that this is a chart that looks pretty similar to a lot of other charts that we've seen lately. A high point that we established here earlier in the year, then a gradual decline, a plunge on the tariff-related news, now a resurgence, and an encounter here at our previous highs, the 62 level, this red line here. So you can see that price has broken above its moving averages, broken above this downward sloping trend line beginning with those highs, and is now testing a notable prior ceiling here. So if we do get the push to the upside, 66.50, that old intraday high here on the year, that seems like one point that many traders likely would have their eye on. RSI continuing to rise and may approach that overbought area if we were to continue to rally here. And if we were to look at some of our other studies here, we've got our volume profile point of control lining up with our moving averages, giving us a notable confluence near about the 59 level. So that could be an area to look for support.
All right, an area to look for support. And you said 66.50, a level to pay attention to the upside. Anything you're noticing about volume patterns?
Well, you know, the volume is heaviest here around that 58, 59 level. So this is the heavy trading area where you could find some consolidation. But price seems to have pushed above it. There's not really a ton of clear volume nodes to the upside beyond that. If we were to look at our 5-year chart too, that these are the 5-year highs that we're approaching. So relatively lightly traded territory that we're entering in.
All right, Rick. That's our Rick Ducat, lead market technician. Now to take us through an example trade, we've got Tom White, senior options contributor and co-host of Fast Market. All right, Tom, so how would you approach an example trade for Cisco, especially given that we've got earnings due after the bell today?
Well, rather conservative, I think. Implied volatility levels with the VIX falling to lows that we haven't seen since the end of March, the rally back that we've seen over the last 3 to 4 weeks here in the equity market. It's kind of compressed implied volatility levels in Cisco going into this report. Now, the option market's pricing in about a plus or minus $2.90 move either way, so roughly about 5% move either way in the share. So I looked at something a little bit more conservative. It pays over a 2.6% dividend yield on this stock. So I looked at a strategy, a covered call strategy, a buy right we sometimes call this, where I can own the shares, collect that 2.6% dividend yield, but then also I can sell an out-of-the-money call against my long stock that also creates yield. So you're getting the double bang there on yield drawn from owning the shares. So in this covered call strategy, for every 100 shares of stock you buy, we're going to sell an upside call out of the money to the upside here on the 63 strike in the May 16th monthly options that expire in just 2 days. So this is really short-term positionings initially, right? But you have that potential to roll or adjust that short strike on a week-to-week or month-to-month basis, creating more credits, lowering your break-even, increasing more yield on this position. So if you buy 100 shares of stock, you sell one of the 63 strike calls in the May 16th, you're going to pay roughly about a $60.90 debit. That's about a 1.5% cushion to the downside to that break-even, which is the price you pay, $60.90. So you're buying the shares at a discount because you're selling that 63 strike call against your long stock position. And as I mentioned, as we get closer to expiration over the next couple days, say the stock just kind of hovers around the 60 level, maybe goes a little bit higher, you'll have that option to roll or adjust that 63 strike. You can roll it out another week. You can roll it to a different strike. The idea here is to keep your stock, collect that dividend yield, but then also continue to collect credits on that short call that you sell against your long stock. So a little bit more conservative. The stock's outperformed the overall market. Implied volatility levels relatively low. But this is a strategy where if you want to own the shares, why not create some yield while you hold it?
I love how thorough you are with the example trades, Tom. Thank you, Tom. That's a covered call strategy for an example trade for Cisco.